Imagine a stock that has completely fallen off a cliff, like down 76% in just the last year alone.
Yeah, that is a brutal drop.
Right. I mean, you were watching it drop from a 52-week high of nearly $85 all the way down to, well, just about 20 cents.
Oh, wow. Just 20 cents.
Yeah, and the algorithmic trading models are just throwing up giant red flags everywhere, actively labeling it a sucker stock.
Which makes sense when you look at the momentum. It's gone.
Exactly. The charts look grim. Retail traders are getting wiped out. But here is where the story kind of breaks your brain.
Okay, I'm listening.
Despite every quantitative alarm ringing, the people running the company, the actual executives inside the building, are aggressively buying up shares with their own money.
See, that defies every standard model we have for market behavior.
It really does.
We're looking at a microcap company here, right? Nuburu Inc., trading under the ticker BURU. And it presents us with, like, the ultimate market paradox.
A massive paradox. Welcome to today's deep dive, by the way. Our mission today is to pull apart the latest data from mid-April 2026 and figure this out.
Right, because you have the cold, hard historical data screaming that this is a value trap marching slowly towards zero.
Yeah.
But that clashes head-on with human insiders betting heavily on a, wildly undervalued turnaround.
To figure out if that terrifying chart is hiding a massive opportunity, we have to really look under the hood. Because looking at BURU right now, it feels exactly like watching a slow-motion train wreck.
It really does.
But that insider activity makes you wonder if that twisted metal is actually, a transformer in disguise, just waiting to stand up.
I like that analogy.
Thanks. So let's establish the baseline reality of their financials, because the sheer scale of the bleeding here is, it's hard to wrap your head around.
The scale of the disconnect between what they spend and what they make is staggering. I mean, we are talking about a publicly traded company on the NYSE American Exchange.
Right.
But their trailing 12-month revenue is essentially a rounding error.
How bad is it?
It's roughly $150,000.
Wait, 1,000, not millions.
1,000, yeah.
You could literally make more money running a moderately successful neighborhood coffee shop.
Exactly. Yet, they are spending hundreds of dollars for every single dollar they actually win.
That is wild.
When you look at their levered free cash flow, they are burning through roughly $35 million a year just to keep the lights on.
So they're making $150,000, but burning $35 million.
Yes. The net losses are carving out a massive crater, hitting negative $71.75 million over that same 12-month period.
Man. And if you break that down to the individual share level, for a stock that costs 20 cents, they're losing $2.25 per share.
Which brings up the most glaring contradiction on their balance sheet.
The cash, right?
Yeah. With that kind of catastrophic cash burn and almost zero actual revenue coming in the door, traditional logic dictates their bank accounts should be running on fumes.
But they aren't.
No, they are sitting on nearly $25 million in total cash with hardly any debt. Just like over $1 million in net debt.
It's the classic scenario of the chronically unemployed friend who is constantly complaining about being broke, but somehow just pulled up to dinner in a brand new custom sports car.
That is the perfect way to put it.
You're like, you don't have a job. Where did the money come from? And Nuburu clearly didn't earn that $25 million from selling their products.
Right, because there's no revenue.
And with no real revenue, no bank is giving them a massive traditional loan. So how are they paying for the sports car?
They sold off pieces of themselves.
Yeah.
The lifeline keeping Nuburu afloat is entirely reliant on external capital. When you dig into their cash flow statements, there is a massive $58 million influx from financing.
So they're continually going out to the open market and issuing millions of new shares to raise cash.
Exactly. Which brings us to the bear case. They are surviving by diluting the current shareholders.
Every time they print a new batch of shares to raise money, they slice the existing company pie into thinner and thinner pieces.
It's a brutal, invisible tax on the retail traders who are holding the stock, hoping for a bounce. And
the cost of that survival strategy became very visible recently with their reverse split, right?
Very visible. They executed a 1-for-4.99 reverse split paired with a $12 million public offering.
So they basically took every 5 shares an investor owned and consolidated them into a single share?
Right, which doesn't actually make the company any more valuable.
No, it's just a cosmetic fix to artificially pump up the share price. You only do that when you are terrified of the exchange kicking you off.
Exactly. The NYSE American has strict minimum price requirements.
And if your stock trades for pennies for too long, you lose your listing entirely. You lose access to the major capital markets. So they slapped a bandage on it to stay on the board.
But it's a bandage that couldn't stop the underlying bleeding.
No.
The stock has plummeted roughly 80% in just the last quarter alone.
80%. Wow.
And the daily price action is incredibly volatile.
Yeah.
I mean, we are seeing violent single-day price swings of over 7% on really high volume.
It is an incredibly dangerous environment for short-term traders. I was looking at their technical indicators to see if there was any floor to this freefall.
And what did you find?
Well, the short-term trends are incredibly weak. ChartMail rates them a 1 out of 10. It's trading below the 5-day and 50-day moving averages.
Which is to be expected.
Right, but there was one anomaly that caught my eye.
Oh.
The current price of 20 cents is actually sitting a tiny fraction above their 200-day moving average, which is at roughly 19.8 cents. Usually trading above a long-term average is a bullish signal, a sign of underlying strength. But given the context of the dilution we just talked about, I'm guessing this is a mirage.
Oh, it's a complete mirage.
I figured.
Yeah, context changes entirely how we read those technical indicators.
Right.
The recent drops in the stock price have been so intense and violent that they acted like an anchor.
Dragging the average down.
Exactly, dragging that long-term 200-day average down at record speed. The fact that the current price happens to be a fraction of a penny above it is just an anomaly of the math.
So it is not a sudden resurgence of buying pressure.
Not at all. And that explains why the momentum indicators are basically throwing their hands up.
Yeah, the RSI, the Relative Strength Index, is sitting right around 46, which is basically neutral, aimless territory.
And the MACD, which measures trend momentum, is flashing mixed but mostly bearish signals.
When a stock is in an artificial free fall driven by massive share dilution, traditional momentum scores break down completely, don't they?
They break down because they are trying to measure organic market demand, but they are being fed a chart manipulated by corporate survival tactics.
Right.
The institutional algorithms look at the zero revenue, the massive supply of new shares hitting the market, and the plunging chart, and they just stamp sucker stock on it.
Which is why the consensus from analysts is a flat sell or hold. If the technicals are this horrific and retail traders are just getting diluted into oblivion, isn't calling this a sucker stock an understatement?
Well, it goes to the core of what a value trap actually is.
Right.
A novice investor opens their brokerage app, looks at the chart, and thinks, wow, this was nearly $85 a year ago. Now it's 20 cents. It's incredibly cheap.
They anchor their expectations to that old high. They think if it just bounces back to $5, I'll multiply my money overnight.
Forgetting entirely that the company trading at $85 had a completely different share structure. It hadn't been heavily diluted yet.
Exactly.
When you factor in the massive flood of new shares they've created and the reality of a massive negative cash flow, paying 20 cents today might actually mean you are drastically overpaying.
Overpaying based on the fundamentals, yeah. The dilution is the brutal toll retail traders are paying for management to buy time. So the technicals are a 1 out of 10. The dilution is rampant, and the retail traders are getting crushed to fund this $35 million annual cash burn.
Yep.
But, I mean, management isn't just setting that money on fire for fun.
No, they aren't.
They're fighting desperately to stay listed, and they're sitting on $24.6 million in cash right now. What is the actual survival plan they are buying time for?
They are attempting a massive, high-risk strategic transformation.
Okay, the bull case, let's hear it.
Nuburu is pivoting away from their previous commercial focus and trying to reposition themselves entirely as a defense-focused technology platform.
Wow.
Yeah. They are expanding aggressively into counter-drone technologies and specifically laser dazzlers.
I want to pause on that because pivoting into the defense sector is not like deciding to open a new branch of a restaurant.
Not at all.
It feels like a dying blockbuster video store deciding overnight that it's going to become a high-end global cybersecurity firm.
That is a leap.
Right. The barriers to entry in military tech are famously brutal. You are dealing with complex government clearances, massive procurement bureaucracies, and, entrenched legacy contractors who have spent decades building relationships with the Pentagon.
It's a very closed ecosystem.
So let's unpack this. How realistic is it for a microcap company struggling to keep its stock price over 20 cents to suddenly become a defense contractor?
Well, the barriers are incredibly high, yes. But the nature of modern warfare is shifting the landscape in real time.
How so?
If you look at conflicts globally right now, the airspace is completely dominated by cheap commercial drones.
True.
Traditional defense contractors are struggling to provide cost-effective ways to neutralize a $500 off-the-shelf drone. You don't want to shoot $1 million Patriot missile at it.
No, the economics of that defense strategy just don't work.
Exactly, which is where the laser dazzlers come in. We are talking about directed energy weapons.
So you aren't necessarily blowing the drone out of the sky. You are using intense targeted laser light to permanently blind or disable the optical sensors on the drone.
Right, rendering it completely blind and useless.
And if Nuburu actually has proprietary foundational laser intellectual property that can be weaponized in that specific way,
Then that underlying tech is highly valuable, regardless of how bad their current balance sheet looks.
okay, that makes sense.
And they are actively acquiring the architecture to deploy that intellectual property. They are partnering with a firm called Maddox Defense,
Right.
and they're currently integrating a massive 70% stake in another company called Tekne. They're trying to bolt their laser technology onto existing, proven defense frameworks rather than starting from scratch.
And the crazy part is there is actual tangible proof that this isn't just a pipe dream.
Yes, there is.
It's not just a fancy PowerPoint presentation to appease angry shareholders. The data highlights a recent $250,000 defense order they secured from the APAC region, the Asia-Pacific market.
Now, while $250,000 barely covers a fraction of their monthly operating expenses, the dollar amount is secondary to the validation.
It serves as a critical proof of concept.
Exactly. An international government entity looked at their technology, tested the waters, and signed a check.
So if that APAC order is legitimate and this Tekne integration works, it completely breaks the current valuation models.
Completely. We aren't looking at a failing commercial tech stock anymore. We have to evaluate them as a ground floor defense player.
And defense contracts, once you actually land them, are notoriously sticky.
Very sticky. Governments don't like changing suppliers once a weapons system is integrated into their broader network.
Right, so it creates a pure binary setup for the stock's future.
It does. If they conduct these upcoming prototype demonstrations for government agencies, and the tech fails, or they can't manufacture it at scale, the bear case wins entirely.
The $24 million in cash burns up, the dilution accelerates, and the company likely folds.
Yep. But if they secure recurring, sticky defense contracts, the entire paradigm shifts.
And that intense binary tension brings us to the absolute most baffling data point in this entire stack of research: the behavior of the insiders.
Ah, yes. The insiders.
We know retail investors are trapped, the institutional algorithms are screaming sell, and the technical charts look horrific.
Horrific is a good word for it.
But then you look at platforms tracking insider sentiment, like stockinvest.us, and Nuburu has a perfect insider score.
100 out of 100.
Wait, a perfect score. The company is burning cash, diluting shares, and the chart is a cliff dive, but the insiders are hoarding the stock.
They are hoarding it. The sheer volume of that internal buying is what stands out.
What are the numbers?
Over the last 100 tracked trades, the people inside the building executives, board members, the people who see the daily operations, purchased an astronomical 22.1 million shares.
That is insane.
Conversely, they only sold about 831,000 shares.
In just the last quarter alone, while the stock was actively plummeting and retail investors were panicking, the insiders reached into their own personal bank accounts and bought over 355,000 shares.
Yeah, that's roughly $216,000 of their own money put on the line, while the market cap was shrinking to just $31 million.
It forces us to examine the corporate psychology at play here.
Absolutely.
Executives at a struggling company are acutely aware of their financial runway. They know the exact daily cash burn rate.
They know the listing risks with the exchange better than anyone.
They see the same terrifying charts and moving averages that the retail traders see. You don't throw 200 grand of your own cash at a sinking ship just to boost team morale.
No, you definitely do not.
Are they delusional, or do they know something we don't? Do they see something in that Maddox Defense partnership and the upcoming prototype tests that the algorithms simply can't price in yet?
It goes back to what legendary investor Peter Lynch famously observed about the market.
Remind me.
He said insiders will sell their stock for a million different reasons. They might be buying a vacation home, paying for a kid's college tuition, or just diversifying their portfolio.
Right.
But insiders only ever buy for one single reason. They genuinely believe the price is going to go up.
Which exposes the massive blind spot in quantitative trading models.
Exactly. Algorithms are entirely backward-looking. They scrape the microscopic revenue history, the massive dilution, the net losses, and they project that same historical misery forward.
But human management is forward-looking.
Yes. They aren't betting on the financial results of the last 12 months. They are betting on the outcome of the defense pivot.
It is the ultimate friction point of the stock. You have an immovable object, the horrific historical financials, and the brutal dilution tax meeting an unstoppable force, massive, overwhelming insider conviction.
Well said.
So if you are listening to this and trying to logically frame where this stock goes from here, how do you even navigate that kind of friction? You can't just flip a coin.
No, you navigate it by breaking the catalyst down into distinct time horizons. You have to look at the immediate triggers versus the long-term gambles.
Okay, let's look at the short term.
In the short term, the next few weeks are critical. The upcoming Q1 2026 earnings in May act as the ultimate put-up-or-shut-up moment for this defense pivot.
The market isn't going to accept any more vague promises about synergies and future integrations.
No, they're going to demand to see if that APAC order and the Tekne integration are actually translating into recognizable recurring revenue.
Or if the company is just burning through that $24 million lifeline with nothing to show for it.
From a purely technical perspective, there is a hard psychological support floor at roughly 15.3 cents.
Okay.
If the earnings disappoint and it breaks below that support level, we are in incredibly dangerous territory for the stock's survival.
And on the upside?
If the news actually validates the defense pivot, resistance sits at 23, 25, and 47 cents. The short-term analyst targets are all over the map, ranging from a bearish 8 cents up to recovery targets in the low 40s.
And looking past May into the medium term for the rest of 2026, it's all about those government prototype demonstrations, right?
Entirely.
Yeah.
They have to prove the laser dazzler tech actually works in the field.
But when I looked at the long-term analyst projections out to 2030, the models are just completely broken.
Yeah, they're a mess.
You have analysts predicting anywhere from 4 cents on the absolute low end all the way up to 96 cents.
Which is a huge spread.
Predicting a stock will either drop to near zero or nearly quintuple in value is like weather forecasters saying tomorrow will either be a blizzard or a heat wave.
Right.
It's a completely useless forecast. How do you even model that?
You don't. Because traditional valuation models require predictable cash flows, which Nuburu absolutely does not have.
So you treat it as a speculative venture?
Exactly. You cannot treat this like a stable, established blue-chip stock. It is a highly speculative venture capital-style bet occurring on the public market.
Right.
The entire equation boils down to a literal race against the clock. Can the revenue from this defense pivot scale up fast enough to outpace their massive cash burn before they drain their final $24 million?
The tension is just unbelievable. I mean, on paper, you have a 76% price collapse, a brutal history of shareholder dilution, and a microscopic trailing revenue of just $150,000.
It looks terrible on paper.
But underneath that wreckage, you have a high-stakes pivot into military laser tech, international proof-of-concept orders, and a staggering insider buying spree that makes absolutely no sense unless the people in charge know a massive shift is on the horizon.
It's a fascinating dynamic that requires looking way beyond the surface level. But there is one final piece of the puzzle to consider before we wrap up today. We've looked at the macro trends, the business strategy, and the historical charts. But the micromechanics of the current price action hold a secret of their own.
Okay, lay it on me.
If you want to know who is really controlling this stock right now, you need to look at the level 2 order flow.
For anyone who hasn't looked at level 2 data before, it's basically the X-ray of the stock market. It doesn't just show you the current 20-cent price, it shows you the literal queue of all the pending buy and sell orders waiting in the wings, waiting to be executed.
Right. So take a close look at that queue right around this 20-cent level. Ask yourself what you are really seeing in the order book.
What are we looking for?
Are there massive hidden buy walls being quietly constructed by those same insiders, designed to absorb the retail panic selling without driving the price up too fast?
Wow.
Or are institutional sell walls sitting just pennies above the current price, acting as a concrete ceiling, ready to crush any short-term momentum the moment retail traders try to spark a rally?
Man, so is the transformer finally standing up, or are the algorithms just building a bigger, more complex trap in the wreckage? That is the question you have to answer. Keep digging into the mechanics, keep questioning the consensus, and never take a chaotic chart at face value. We will catch you on the next deep dive.